As you approach retirement, the last thing you want to deal with is tax mistakes that could cost you thousands of dollars. Understanding how to avoid common tax mistakes in retirement is crucial, and today I'm going to break down the top tax errors retirees make and how you can avoid them. One of the most significant mistakes retirees make is underestimating how much tax they'll owe on their retirement income. Many people think that withdrawals from IRAs or 401ks won't impact their tax situation, but in reality, those withdrawals are taxable as ordinary income. That means if you're withdrawing large sums from your IRA or 401k, you could be bumping yourself into a higher tax bracket than you expect. It's important to plan your withdrawals carefully to avoid unexpected tax burdens. Another mistake many retirees make is neglecting required minimum distributions, or RMDs. The IRS requires you to start withdrawing from your traditional IRA and 401k once you reach age 73. If you fail to take your RMD, the penalties can be steep, up to 50% of the amount you should have withdrawn. Make sure you stay on top of these requirements and consult with a tax advisor to ensure you're meeting all obligations. Then there's the issue of tax inefficiency in your investment strategy. Some retirees hold taxable bonds or stocks in their taxable accounts, not realizing that these investments can be hit with taxes on interest and dividends. If you want to avoid this, consider shifting these investments into tax-deferred or tax-free accounts like a gold IRA. Gold IRAs allow you to grow your wealth tax-deferred or tax-free, and they're a great option if you're looking to protect your savings from market volatility while minimizing your tax liability. Speaking of gold IRAs, if you're serious about protecting your wealth, especially if you have 100K or more in your IRA or 401k, I highly recommend you check out the first link in the description. Thousands of Americans are turning to gold IRAs to safeguard their savings from market fluctuations and tax inefficiencies. You'll get a free guide that shows you exactly how to diversify and protect your retirement funds, no strings attached. Now let's talk about tax brackets. Many retirees get surprised when they move into a higher tax bracket due to a lump sum distribution from a retirement account. It's crucial to understand how your tax bracket works and how to manage your distributions to avoid jumping into a higher one unexpectedly. Consider spreading out large withdrawals over several years to keep your taxable income within a manageable range. Another critical point is healthcare expenses. A lot of retirees overlook how their medical costs can impact their taxes. Medical expenses that exceed 7.5% of your adjusted gross income are deductible, but many people don't keep track of their medical expenses. This can mean losing out on potential deductions come tax time. Make sure you're keeping receipts and tracking your medical expenses to make the most of these potential deductions. And finally, let's talk about the danger of not working with a tax professional. It might seem tempting to handle everything on your own, but retirement tax laws are complex, and the consequences of getting something wrong can be severe. If you're not already working with a tax advisor, I highly recommend doing so, especially if you have significant retirement assets like a 401k, IRA, or even more than $5 million.